good afternoon, good morning, depending where you are based, and welcome to this late afternoon Boardman Grow webinar, which we're hosting together with our partners Business Finland and PwC. My name is Jussi Luhtasela. I'm a CEO for a Finnish Helsinki-based SaaS company called Recright, and I'll be moderating this webinar today. Our aim for the next 1.5 hours is to provide in-depth knowledge about the markets in US and perhaps dispel some of the myths that we Finnish entrepreneurs might have about entering the US market. Our two experts, Val Kratzman and Patten, will give us each a 30-minute presentation, after which we will have time for some Q&A and discussions. Please post any questions you might have into the chat box during the presentations. You can find that on the right-hand side of, or in the bottom of your Zoom screen, and I'll ask them from our experts at the end of the session. But I would say, without further ado, let's give the floor to our first speaker, Val Kratzman. Val is an international business strategist and a market entry expert who's worked with startups throughout Fortune 100 companies. Currently, he guides Finnish healthcare companies through technology validation to clinical and commercial use. And Val has an extensive experience in helping Finnish companies to enter the US market. So we'll be very much looking forward to his presentation. But with that, Val, floor is yours.
Good afternoon, everyone. Let me just go over to get my slides up and running. Can you see my presentation?
Yes.
Very good. So this is kind of a fun topic for me in the sense that you get to kind of talk about things you don't normally talk about, or things that you see and maybe applies to one person, but it could apply to 100 people. So it's what no one really tells you about US. And the main thing is that you need to create a new and different mindset. So, the thought process of cutting and pasting what you're doing in Finland doesn't work. So let's take a look at this. As a preface to what I'm going to discuss, let's kind of put the US into some kind of context. It's big, it's complex, but it's accessible. Now, it's accessible because the rules and the process already exist, and people expect you to follow them. So don't try and change them, learn them, work with them. But more importantly, people will help you if you ask lots of questions. So the first takeaway is don't sell, ask for help. The most important thing is to work locally and work with the local industry experts. You can't do it by yourself. Don't expect to do it by yourself. Don't make promises to your board, to your investors, that you're going to be making $1 million in the first year, because you're not. But you also work with the local experts. In terms of complexity, each state, each market, and each industry has its own variations, depending on where you are in the United States. It depends what the market. For example, Coca-Cola has 11 different formulas, different flavors for the United States. So it kind of gives you the idea of cultural and regional variance. But you also want to enter the market where the market tells you to enter, and you do this by doing market research. You come over and spend a lot of time in the market. My recommendation is come to the market early, come to the market often, and don't come when you have a final product. Come before you have that product finalized, because you will have to pivot and change it. And there are some basic myths I like to dispel, that you have to be in California, Boston, and New York. Great places to hang out, great places to learn. You don't need to grow there. A lot of my success with my companies are coming from places: Winston-Salem, North Carolina, Philadelphia, Atlanta, Denver. So it's a big country, and we'll talk about that. This is a kind of an interactive map that I have on the right. It comes out of Harvard, their atlas. I don't think the internet's going to let me work the way I want it to work right now. But each one of these blocks represents an industry. And you can click on it, and it pulls up all the necessary statistics. So it kind of shows you how deep you can drill down into information about the marketplace, if you're so inclined. So let's start by understanding the playing field. There are things that you see, things that you do not, and things that are expected of you. So the most important thing is to do your homework, not just go to Google, but talk to people. There are tons of trade associations in the United States. Every industry has a trade association or two or three. Every industry has trade journals. There's a lot of information. For healthcare, you can go to the National Institute of Health. It's called reporter.nih.gov, and it will show you every penny that the National Institute of Health spends on research in the US. And the beauty of that database is it gives you the email address and the telephone numbers of the people working on it. So you have a network already built in. You just have to figure out where you need to go to collect information. And the most important thing is if you do good market research and you do it right, it only takes 45 days to figure things out. So as I said, ask questions and don't sell. Finland and the US are not the same. The US is not Europe. There are cultural differences. They're real. There, as I mentioned, Coca-Cola has 11 different formulas of flavors. So there are national and regional. The distilled industry, the liquor industry in the United States, they actually break it down into 95 markets. The automobile industry breaks it down into 7 markets. So it's not one market. So keep that in mind as you move forward. Forget normal working hours. No, the joke is the New York City, the city that never sleeps. Very, very important, but it's very, very true. I get a lot of stuff done on Sunday nights because that's when CEOs are on their emails. So I can send out emails from 9 o'clock to midnight on Sunday nights and I can get responses. So it helps me start my week. Finish vacation, forget it. No one's going to accept that you're disappearing for 30 days. So just be prepared for that. One of the interesting things that we've seen in the United States over the past couple of years is American workers are afraid to take time off. The competition for jobs is fierce at times, and people feel that they need to be in the office for job security, or they feel that they need there just because it's what they're doing. So there's another cultural difference. As a result, consistency is never guaranteed. What you see in one state, what you see on the West Coast, the East Coast, going to be very, very different. And one of the jokes I had is once you start working in the US, you'll never eat lunch properly again. And here's one of my most favorite ones that I've saved it to last. Your restrooms will have a big difference on the effect of your success. Now, this is very true for the retail industry, the hospitality industry, restaurant industry. But what it tells us is that there are things that people are going to be looking at about you and about your business that you don't think about. So it's very important to do. We talk about, I'm a Wharton graduate, and we talk about the consumption chain, not the value chain. So if the value chain is linear, the consumption chain is everything that evolves around the value chain. So we pay attention to details that you never even think about. So in perspectives, I got 3 slides on perspectives. Here's a geographic perspective to kind of show you the US versus Europe. But more importantly, you can see Florida and Finland are close to the same geographically landmass size. Or you can say you can put 1.3 Floridas into California. So that's one way to think about it. And then if we start thinking of the time difference, we have 3-hour time difference between the East and West Coast. So that means 7 to 10 hours from Finland. If you want a longer working day, you hang out on the East Coast. If the working day doesn't matter, then and if you have to be on the West Coast, we go to the West Coast. So we can also basically look at the United States in terms of European or global companies in terms of GDP. So you see Finland's down in the bottom there, and it's basically the same GDP as the state of Louisiana. So these are things to take into consideration. Is there a population there for me? Is there a workforce there for me? Is there the venture capitalists there for me, or the strategic partners there for me? These are all questions that you need to ask yourself as you look at the United States. Now, I don't know if I agree with these maps, but these these maps kind of break out the United States by industry, by each state, where are the hot spots for industries. I kind of laugh that California says finance. Maybe they should be saying venture capital. But down here, Texas, New Mexico, absolutely, that's energy, that's oil money. So each map is going to be a little different, but I think what's important is for you to understand that there are these differences and how do they apply to you? What is their significance to you? So it's not one market. You cannot do it alone. The best thing is to figure out what region you can start with. A lot of times I'll say, start someplace where you can fail and no one's going to know that you fail. It's always easy to start small and somewhat invisible, and it works. Now, there's a hospital right here in Sioux City, Iowa, Sanford Health, and I love working with them. And the reason I love working with them is they're financially secure. They're funded by a family office, but they also have operations in 25 states, which is unheard of in the United States, and they're easy to work with. So you can go out to Sanford Health and fail, and the people in California, the people in New York, Boston, Chicago aren't going to know. So that's something to take into consideration. And the most important thing is look for the best local partner, not the first. A lot of Finnish companies say, oh, I found someone who wants to distribute. This person met me at a trade show in Europe. Those are the people to avoid or be more cautious about. What you want to do is you want to interview 10, maybe 15, meet 10 or 15 people, and then figure out which one really is best for you. So there's no need to jump. There's no need to go fast. So it looks like my got a T there. But anyway, this is a fun little map. It's a comparison to how resources are spent in the United States and Finland. So if we say that Finland is a small, homogeneous, easy to reach technology-oriented marketplace, the US is large, multicultural, noisy, hyper-competitive marketplace. But if you compare on how resources are spent, management and finance are almost the same at 30 and 35%. I tend to say that 5% difference is sales commission and CEO salaries. Years ago, when I did a lot of work with instrumentary imaging, there was one salesperson in the US. Her annual commission was $1 million plus, and people in Helsinki got upset. And I turned around and said, yeah, it's $1 million because you're paying her to sell machines. She's selling 70 or 80 machines where everyone else is selling 20 or 22 machines. Of course, her commission is going to be bigger. So as the CEO or the export manager of a company in Finland, be prepared for the discrepancies, or should I say the disparities in the size of commissions and salaries. Now, Finnish companies put 50% of their resources into technology and product. Okay? And then they put 20% into product marketing. The United States puts 25% into technology and product and 40% into product marketing. And that's an inverse 2-to-1 ratio. And why is that important? Well, first of all, it's not about the technology. The best technology doesn't win. The best marketed technology wins. Hence 20% versus 40%. But it's also about having what's called a marketing to engineering ratio that's greater than or equal to 1. This is research that came out of MIT in the late 60s, early 70s. And in the process of documenting this formula, they actually documented 2 suicides where people put all their extra money into the technology, but not into the marketing. So what it really says is for every dollar that you spend to design the product, you have to spend $1 or more to understand the user. So what it really says is that you have to understand the user before you design the product. So Finland is at a negative 2-to-1 ratio. Oh, I'm sorry. Finland is at a negative marketing to engineering ratio, where the US is at a positive marketing to engineering ratio. Apple's marketing to engineering ratio is 21. They spend 21 times more money understanding the people than they do to put the product on the market. So that's a very important thing to remember. So let's talk about expectations and reality. Typically, expectations between the CEO, the investors, the board are misaligned. And a lot of it is because you fall in love with the technology, but you don't fully understand the market. So I tend to say, how market ready and how market aware are you? As a result, I can go back years ago to a company called CRF Health. They told me they were going to, and I still work with Timo and those guys today. No, they said they're going to make $2 million in the first year. I said, no, you're going to make $1 million. You're going to spend $2 million in the first year. The reality is that they were persistent. They learned, they pivoted, they were flexible, and they became the gold standard for their technology in the marketplace, plus on a global basis. So we also talked about that the US is big, it's complex, and it's approachable. but it's receptive to the right offering, not every offering, but the right offering. So you have to deliver market-defined benefits and solutions. As I said, they're not going to buy the technology. They're going to buy the benefit, the solution, and the value that you can deliver. And it's their clock, not your clock. And then with COVID, that clock changed. We used to say in healthcare it was a 3 to 5 year process. Today we're saying it's a 5 to 6 year process, if not longer. So don't think it's going to happen overnight, because it may or may not. And you have to design for the market. So you need to listen, you need to change, to pivot. And you remember that no one buys products, they buy benefits and solutions. So contextual relevance. The question is, what is market entry? And when I used to teach at the Wharton Business School, I would say, if anyone tell me the definition now, as we start, you can get an A in the class, and no one has. And the problem is, everyone thinks market entry is about selling, or finding a distributor, or finding a strategic partner. Here's another question. Are you going to love the company, or are you going to love the product? The correct answer is you're going to love the company, because the product's going to change or the product will go away. So the answer is strategic business options. Always think about, what is it that I'm going to do to grow my company? My business is what's going to be anchoring everything, not the product. So there's tons of solutions out there. Those are your competitors. But you also have to say, oh, if this doesn't work, then this can work. What problem do you solve? You need to show a specific market-defined need. So problem and need have to match. You need to position yourself as a solution, and you need to know who's going to buy it and why. And we tend to call that value proposition. You need to spend a lot of time on your value proposition. And I like to say, your value proposition should be no more than 7 words, and a 10-year-old should understand it. So it's all about the company meeting someone else's need. So forget about trying to sell. This is kind of a fun graphic with respect to perception, listening and not listening. How the customer explained it, how the project leader understood it, how the engineer designed it, how the programmer wrote it, how the sales executive described it, how the project was documented, what operations installed, what the customer was billed for. You got to love consultants sometime. And how the help desk supported it, and what the customer really wanted or needed. So listen, ask tons of questions, do not sell, and you'll be amazed at how fast things can move and how well things can move for you. Now, anyone can pitch, all right? The question is, can you effectively have an intelligent business conversation for 30 minutes after that pitch? And this is a TED story on storytelling. And it really does highlight the most important things. That you want to be memorable. You want them to remember you. So there has to be an emotional play and a passion play. You can talk about saving children's lives. You can talk about this or that, whatever you wish. But it has to have passion behind it. It has to be new and different, but not so new and different that people say that's never going to happen. That's impossible. And at the end of it, they have to have this visual image of you in their mind and them using your product. And that's what makes a good pitch. I tend to say, if you can get to the 3rd slide and the 3rd slide tells the whole story, the rest of the pitch is easy. So that means that you really have to say, what is the right problem? What is my value proposition? What is my solution? And you need to do it in 3 slides with no more than 5 lines of text per slide. So this is some fun information. Stories are 22 times more memorable than facts. So we talk about the ineffective science story or the effective marketing story. You don't want to tell them that you have a factory that's so many thousand square meters and that this is where the science came from. And these are the different things that you went through. What they want to know is what problem you're solving. So facts do not interest people. And this was a quote from Steve Jobs, the most powerful person in the world is a storyteller. The storyteller sets the vision, the values, the agenda of the entire generation that is to come. And storytelling can increase revenue. So if nothing else, that's why you want to have a good pitch and story, because it will make you money. A bad story shuts the doors on you. There is so much information that is daily bombarding people in the United States. Having that 7-word value proposition really is your secret sauce. It's what's going to make you stand out. Daddy, instead of a story, can you read me some brand content? So they talk about that digital marketing experts estimate that most Americans are exposed to 4,000 to 10,000 ads a day. So the question I ask you is, how are you going to differentiate yourself? The amount of time you spend for your market research, figuring out your value proposition, it all pays back in the end when people start saying to you, how can we work together? Not how can I buy, how can we work together? The old day of exporting into a distributor and the distributor selling the product is over. Your distributor is a strategic partner. They will expect that you're going to pay marketing dollars. They're going to expect you're going to share trade show events. They don't expect you to just sell them the product and abandon them. So it is a strategic partnership. Now, I've talked about value proposition. So what is value proposition? It's how you effectively glue technical feasibility and product manufacturing with business viability and product desirability. How do we do it merges with why we should do it. The technical solution and the business solution makes sense, and they feed off of each other. They support each other. And as a result, you get a value proposition. They want to hear your effective story. They want to know that you understand their business as well as they do. Gee, I love what you're doing. This is why I have value to you, because you're putting this product in the marketplace for the oil industry, and it's really not sustainable. It doesn't work for you. Your people are spending 110 hours. They only need to spend 6 hours if they use mine. That gives them more time to do other things for your company. It's that type of insight is critically important to your success. And it comes by talking to people, going to events, and not selling, but asking questions. Tell me more. Most Americans will be glad to help you. Most Americans will run away if you want to sell them something. There's a doctor I work with who used to be the CEO of Thomas Jefferson University Hospital. And he's one of the most sought after docs in the country. And in a public forum, I got up and asked him a question, and he said, stop. And he says, before anyone listens to Val's question, the reason I work with him is because he's never tried to sell me anything. And I was very embarrassed that he said it, but it was the truth. You have less than 30 seconds to convince them to give you 30 minutes. The goal of the pitch is not to get money. The goal of the pitch is to get the second meeting. The goal of the second meeting is to get the third meeting. The goal of the third meeting is to have an intelligent conversation how you guys can make money together. So don't expect the pitch to get you money. And there's only been one case that I've seen in my entire career where someone got up. There's a company called Beambrush. They got up. Their entire presentation was automated on a slideshow. The person introduced himself. He hit the button. 37 seconds later, it was done. He got $4 million, 2 times he presented. It's the only time I've seen that. And the pitch was marvelous. So we're about 10 years later. He's still out there, but he's still not putting Colgate and Crest to shame. So your goal is to optimize the market needs and convince them that you are the audience. You have the solution. And you also have to have a relevant ask. I would like to do this with you. I would like to, get this much money from you. The ask has to make sense. It has to flow with the entire conversation. So in terms of partner selection, here's a reality check. You need to think very carefully when you hear something like, trust me, I'm an expert. This is why I say, don't go with the first or the second. Talk to as many as you can, then go back to whoever you think is going to help you. And if none of them helps or are going to help you, then start the process over. There's no rule that says I need to hire someone on my first trip, a second trip, or even my third trip to the US. So find the best, not the first partner. Conduct objective due diligence. As an American, I will say this, most Americans lie on their resume. Most Americans will give you references that are going to give you positive, raving, wonderful reviews of that person. Dig deeper. It's illegal for a company in the United States to give a bad reference. It's illegal for the company in the United States to say anything other than, yes, that person worked here as a vice president. So that's one of the difficult reasons to find good information. And by law, private companies in the United States don't have any legal right or legal obligation to give you information on themselves. So sometimes finding information is difficult. Finding the correct information could be even more difficult, but it is there. And I also say, don't just ask another Finn. You can start with the Finns, but on the same token, you really, as I say, you want to talk with the locals and you want to talk with people in the industry. And it is part of that strategic business decision that is part of what is market entry, strategic business options. So I'm going to match that with strategic business decisions. And you don't necessarily have to like the person, it helps. But at the end of the day, you just have to get the money done. So your proper partner will probably not be who you think it is. There's 28 million small businesses in the United States. They outnumber corporations 1,100 to 1. 70% of them owned by a single person. And small businesses create 13 times more patents per employee than large companies. So the perception of what's out there is not what you think it is. And the other thing is I'll say is that the large, big companies today, the multinationals, no longer innovate. They need small companies who have great ideas, who can move faster than them, who have the ability to say, oh, if we do this and do that, will solve your problem. Don't be afraid to work with a large company. But I will tell you to use an American lawyer to make sure that your intellectual property is protected. Their job is to make money for their shareholders. Therefore, if they're going to do a deal with you, they're going to try and get the deal as cheaply as they can. Your job is to get as much money as for your shareholders. So these are some important balancing acts that you have to take into consideration. And if you think about balancing, value proposition is balancing the business versus the technical. And your market research is a balance between outside information and inside usability of that information. So this concept of dualism is very important as you come into the United States. Be prepared for questions. People are going to ask you questions about Finland. That's great. That's an icebreaker. That's marvelous. But then they're going to have a list of questions they want you to answer. You need to know those questions or anticipate those questions in advance. Venture capitalists, there's a ton of information out in the marketplace about the questions venture capitalists are going to ask you. Be prepared to answer questions equally as much as you can ask questions. So some basic takeaways. Local presence matters. Airplane marketing will hurt you. If you're coming back and forth to the United States, it's great. It shows a commitment. But if you don't have some sort of local presence, you may not get that first sale. The other part of local presence is after-sales service. A lot of technologies, a lot of products need that after-sales service. Is it easily distributed in the United States? You'll hear probably about sales tax and financial issues. E-commerce is a very different game, but if you start selling a lot of product into the United States, depending what state you're in, you're going to be obligated to pay sales tax. So these are things to pay attention to. It will take you longer than you think, so you have to plan for it. And I said, tell your board and your investors. If you think it's going to cost if you think it's going to cost 100, double it or triple it. If you think you're going to do it in a year, say I'm going to do it in 2 years. Just be realistic with your expectations and how the market functions. Americans tend to calendar 3 to 6 months out. Don't ask me, don't ask my colleagues, don't ask anyone, can I have a meeting with you next week when I'm in New York? It's not going to happen. They need to know who you are. Now, the process is very different than in Finland. We use email and voicemail to avoid people in the United States. So when you send an email, if the subject line doesn't interest them, they're not going to read the email. If the subject line is of interest, then they're going to read the first paragraph. If the first paragraph works, they're going to read the rest of it. Don't send anyone 35 slides. They want a paragraph, and then they'll ask you for a slide set, or they'll ask you for a one-page summary. So don't expect people to read slides. They don't. What they really want to know is what problem you're solving and how much it's going to cost me and how much money I can make from it. All right? Let's be mercenary. And I'm in healthcare, and I'll tell you right up front, healthcare is a consumer cash flow model. It's the way it is. People do not want to talk to you. They use email as barriers. I said that. You need to network to 100 people to get to the right people. So, and as I said, coming from Finland, people are going to want to naturally talk to you. It's intriguing. Finland is what I call a neutral positive. No one can say anything bad about it, but everyone's intrigued by it. So you're in a really great starting position to build a network. But don't jump into the fact by saying, I have a factory that makes this and that. The other thing is, when an American asks you, what do you do? It does not mean, what do you make? Because I know in Finnish, the do and words do and make are comparable. When someone says, what do you do? They're asking you what problem you're solving. What are you addressing? What industry are you in? So vocabulary is going to be important. Remember, it's never personal. It's business. Great quote from the Godfather. And there's no room for ego and emotions. It's not personal. If they say no, ask them why. If they say it's no good, ask them why. If they say it's not for me, ask them why. And by the way, do you know someone else who I could talk to? If it feels uncomfortable, so what? Lean into the awkward, act as the boss, take control, and take advantage of the conversation, the fact that you have someone talking to you. You need to be professional. You need to send thank you emails. And once you had a meeting, thank you for the meeting. It was nice to talk to you. Here's the information I promised. I would like to talk to you again, as you suggested, in 3 or 4 weeks. Do not use emojis on your emails, your text messages, or your slides. Price margins are different in the United States, typically higher in terms of what an importer and a distributor gets. So you need to calculate on US dollars and percentages, not on Finnish. What you will find is that your accounting principles are different than US accounting principles. You're going to have to figure out how to align them. And our colleagues from PricewaterhouseCoopers will probably talk a little bit about transfer pricing. Do not think that you can cut and paste what you do in Europe and Germany or Japan in the United States, because it doesn't work. The expectation is that you're going to treat the United States as a primary market, and they expect to see that type of commitment. So there it is. Do not rely on the internet. I've said that a couple of times. You can start with the internet to find things, but you need to go to the next level. And the myth is you need to be in Silicon Valley, Boston. So there are other receptive markets, find them. So in closing, my recommendation is choose where you swim and with whom. So thank you.
Thanks, Val. That was really interesting. Just a reminder to everyone, please drop your questions in the chat box. And before we move to Tom, I actually, Val, have one, because I know that you have a fair amount of experience working with Finnish companies who've entered the US market. So could you share a success story of a Finnish company that's been kind of successful in establishing their business in Finland? And what did they do to kind of avoid the most common pitfalls?
I won't use the name of the company, but there's a company that is in the bioprinting space. Like, you can probably figure it out. And I met them at a Finnish American Chamber of Commerce event. And they were this wide and this deep in their actually this wide and this deep in their thought process, and optimistic and altruistic. The optimism was fabulous. The altruism we had to throw it out the window. But the thing was that if the person was engaging, and they moved to California, and we spent probably 3 months on the slide set. It was a technical slide set. It was something I couldn't show anybody. And to be perfectly honest with you, despite the fact that I've been in healthcare my entire life, I couldn't figure it out. And when we simplified it, and when they brought their technical people on and they brought other people, so we ended up with 5 or 6 people in these team calls back and forth, we were able to get consensus on what we were trying to accomplish. And if any of you are interested, I have a template for an American slide set. It's 13 slides. And I'll be glad to share the template with you. I'm also glad to share a list of 23 top questions. That's no problem. And so we went back and forth, and the slide sets, and then the individual said to me, I'm going to go to this event and that event. And I said, okay, go ahead. But what I saw there was the commitment to go to every possible event, even if it didn't make sense. And they basically invested in their future. They went to event after event. They learned. They came back to me. We talked about it. We modified the slide set. probably after every event. We added new information, we took out information. And then I was at an event called Health Evolution Summit, which is an invitation-only event for the top 500 people in healthcare. And there they were. I had even no idea they were there. So I said to them, you need to tell me that you're coming to these places. So I took them around the room and I introduced them to some of the top CEOs in the country. And they all went in and they looked at the demonstration and there's got a lot of interest. And then we continued to talk more, and they were getting ready to go to the FDA. We got them the FDA experts that they needed. And then I said to him, would Tony Atala at the Wake Forest Institute of Regenerative Medicine be of interest? He said, absolutely. So I made the introduction. 10 minutes into the conversation, Dr. Atala said, you need to be here with us. A week later, that company was in North Carolina meeting with the people there. And at the end of the month, they made the decision to relocate there. So commitment, energy, listening to the market, and taking the risk all made that company a success. And just for reference, the Wake Forest Institute of Regenerative Medicine is the #1 regenerative medicine lab in the world. So Finnish companies can succeed. They can become unfinished in their behavior. I can say that after 30 years. And if you commit to the market and you put the energy into it, the passion, the enthusiasm, you're good. So I hope that's a good case for you.
Thanks for that. How long did it take for them to become successful?
We
From
started
your first meeting with the slide deck.
Well, we started talking probably pre-COVID, and now they moved into North Carolina a year ago. And they probably have 16 full-time people in the US now. So I would say it's a 4-year process.
4-year process. Okay, thanks for that. And everybody, you'll have the opportunity to ask more questions. Well, we'll be hanging around here until the end, so feel free to type your questions in the chat box. But now I think it's time to move to our another guest. And on the line, I saw that we have Tom. Tom Patten is a partner at PwC, and his focus is primarily on European-based multinationals with invest in the US. And he's part of the PwC's global structuring and Washington National Tax Services teams. So moving more into the accounting, finances, and that side of things. Tom, floor is yours.
Great. Thanks. Thanks for that introduction. Really appreciate that. And hi, everybody. Appreciate your time today. This is the tax part of the discussion, so don't be worried. We're not going to go too deep and too technical on tax. What I'm going to try to do is give you a little bit of an overview of how the system works. And this is kind of on the back of key questions that I hear a lot in terms of companies who are expanding into the United States and trying to figure out how the tax system actually works at a high level. And I'll give you a few discussion points, I guess, around also the legislative process and how that fits in, because I think it's important to just make sense of maybe what you might be hearing in the press as it relates to tax changes and whatnot. So let me share. I've got I can't. I'm getting a message saying
yes, just a second, Tom. I will give you the co-host permission.
Okay.
So just a second.
Great. Or if you want to share the slides, that's fine.
No, now you can try. Can you share?
Okay. I also shared that. And if I go to that. Okay. Can you see that?
Yes, that's good. Great.
Great. Okay. So I'm going to start with a little bit of just US tax fundamentals, just some basics of how the corporate system works in the United States. And I think what you might find, I mean, what I will say is actually a big part of my job, being based on this side of the Atlantic, is to kind of translate sometimes what comes out of the US tax community, to ways that persons outside the United States can understand, because often we have a tendency to talk in code sections and deeply technical, because the system itself is very complicated. There is no getting around the fact that our US corporate system is one of the most complex in the globe. I think some of the OECD proposals that are out there do have an impact on larger multinationals to level the playing field a little bit, to be honest with you. But nevertheless, there's a tremendous amount of complexity that one will have to grapple with in dealing with the U.S. system itself. And I think another part of what makes the U.S. system seem complicated is that, as we look at our system compared to other jurisdictions, there's really a higher level of expectation as it relates to documentation of the tax treatment of transactions, or the supporting documents, the legal documents behind that. So that what the IRS, what the U.S. Tax Authority expects is typically, set at a higher bar than other jurisdictions, and that can kind of be a real adjustment as well. So I'll try to help you wade through just some of the basics to get a sense of the lay of the land, if you will. So the U.S. system has a different set of rules that apply to U.S. companies as compared to non-U.S. companies. And by U.S. companies, I'll explain what I mean in a later slide. But a U.S. company is subject to a worldwide income system and a foreign tax credit system. And so what this means is that a U.S. corporate taxpayer is subject to tax on all of its income, regardless of where that income is earned. And to the extent that it earns income in another jurisdiction and it suffers tax in that other jurisdiction, a credit is potentially allowed to reduce the U.S. taxation on that income. We're not the only jurisdiction that does that, but if you compare that with the Finnish system, you compare that with just generally the tax system in Europe, which is to exempt foreign income. There's a massive difference off the bat as it relates to cross-border transactions of U.S. companies versus Finnish companies. And I think that's also important to bear in mind if you think about you are a Finnish parented group and you're looking at competitors that are a U.S. parented group. The corporate tax system itself has the corporate tax system in the United States has different sort of penalties and incentives for foreign investment as compared to what a Finnish multinational might have. And I think in the round, some of those things can be more advantageous for US-based multinationals. And I think you can just sort of see that in the market if you look at say listed companies and the tax strategies of those listed companies and the effective tax rates of those listed companies. Quite often the US has a lower tax rate than you might expect. So it's a 21% tax rate in the United States. From a federal perspective, state income tax applies as well, and I'm going to pick up on that a little bit later. For non-US persons, I would describe that a bit more as a territorial system. So non-US persons that earn income from a business in the United States they are subject to tax on the income related to the business in the US and generally do not have their other income pulled into the US tax net. So this is just to kind of show you a little bit how that all works. So if you have a US person on the right, and those US persons are subject to tax on US income and subject to tax on foreign income, along with a foreign tax credit. And if you have a foreign person on the right, they're taxed on their US source income, but they're exempt from that so-called foreign source income. One of the other things you might need to get used to in dealing with US tax professionals is we say foreign a lot. And when we say foreign, obviously we mean non-US. So I just apologize on behalf of the language involved here, but it's kind of the norm in the tax community. It was very important to have a basic understanding of business entities in the US as it relates to taxation. So we've got 5 listed here. So one is the first one is a sole proprietorship, and I mean, in effect, that's not really a business entity. That is kind of, if you're an individual, that's just operating without a business entity itself. Arguably, that you could consider that as well as a Finnish incorporated entity that then just operates in the United States without a legal entity. We have legal form partnerships as well that can vary from state to state. And in fact, I will say that generally business entities are creatures of state law. And the law under which an entity is formed generally doesn't have that much impact on the overall tax outcome. That is more of a legal issue than a tax issue. And again, I'll pick up on state tax shortly to explain how that can all work. A C corporation is referring to an incorporated entity. So if you see in a company name, ABC Inc., that's what we would call a C corporation. C corporation refers to the part of the tax code that deals with those types of entities. And we also have entities that are also incorporated entities, but make a tax election to have a different treatment called S corporations. That's not really relevant for you because you cannot make those elections if you have foreign shareholders. The last entity is a limited liability company or an LLC. These entities are very, very similar for legal purposes to so-called C corporations. The difference between them more or less is the tax treatment of that. LLCs were created in each of the individual states to give more flexibility as to how an entity might be treated for tax purposes. Because what we have is a set of rules that apply to determine, is an entity treated as a corporation and an opaque entity, so a kind of standalone tax entity that is subject to tax in its own right, or is that type of entity more of a tax transparent entity that does not pay tax in its own right, but flows its income through to the shareholders? So something like a partnership is a tax transparent entity, but what the most important thing to remember on this is that an LLC has flexibility in terms of how it shall be treated from a tax perspective, either as a so-called corporation that is subject to tax in its own right, or as a wholly tax transparent entity. And you'll hear us refer to that as a disregarded entity to an LLC to the extent an LLC has a single owner. So let's say you are a Finnish company, you are advised to set up an LLC, a legal entity in the United States to expand your business. And that may be to just establish a U.S. entity to engage in legal contracts with other U.S. partners. It could be for other reasons. Your starting point might be an LLC just to allow you to determine, do I treat that as a corporation, have that be subject to 21% tax as the U.S. company on which was the left side of the picture that I showed you before, or do I treat that as a transparent entity that I disregard for tax purposes, and I treat that as if the Finnish company is engaging in all of those activities that the LLC does, and I'm subject to the more territorial taxation on the right. So there's an interaction between the legal advice that you have in terms of the type of entity to use. Generally, lawyers will be indifferent between an Inc. and an LLC because they both provide for legal liability to you as well. Again, the state under which they are legally formed doesn't have much of a tax impact. You probably have heard more about Delaware corporations and Delaware LLCs than from any other state. The reason for that is that generally speaking, Delaware has the most developed corporate law and company law, and the most flexibility coming out of that, such that they're kind of relatively easy to use as a legal entity, potentially compared to other jurisdictions. So this check the box election refers to the ability to change the classification of entities under our tax code to be treated as corporations or as transparent entities. It's relatively unique. There are one or two jurisdictions that have actually adopted this themselves. They're generally pretty small jurisdictions, but this was a relatively unique approach to tax and entities in the United States to allow taxpayers to really get the kind of the best legal answer they want and then choose the tax treatment that they want, compared to other jurisdictions that apply a more substance-based approach of companies of any form are subject to taxation, full stop, and partnerships are transparent entities. It's one just quick note on consolidated groups from a tax perspective is that we do have grouping for tax purposes. The basic takeaway from this is that if you set up separate entities, say for legal reasons, because maybe you've got 4 different properties that you're developing and you want legal protection separately from each of those properties, but you want to consolidate as a group from a tax perspective, those entities will need to have a single U.S. parent to combine together. The tax issue with that is that, generally speaking, if you dispose of a U.S. entity out of a consolidated group, it's taxable. We don't have a participation exemption that exempts disposals of companies, again, like other jurisdictions. Whereas if, on the other hand, if you did not have a group, and let's say you had your four companies doing separate business activities, then generally speaking, with some exceptions, then that'll be subject to just the Finnish tax rules who may then exempt an exit or a sale of those entities. State taxation. I would say this is kind of there's plenty in the Internal Revenue Code to kind of blow people's minds in terms of odd rules that take some time to understand as to why are those rules in place and what are they actually getting at, because the outcome is a bit weird. State taxes can be very challenging to get your head around. Part of the issue just is the simple fact of we have 50 states. They each have their own tax law as to how tax applies in those states. And they vary significantly. So some states don't have an income tax. Nevada doesn't have a corporate income tax. Some states have a very high rate of corporate income tax, like California, 13%. And that 13% in California is on top of your federal rate of 21%. It's deductible for federal, but if you operate in higher tax jurisdictions, you could wind up with an overall effective tax rate of high 20s or even in the 30% range. State tax is triggered by something called nexus, and nexus has two aspects to it. Historically, nexus has been a physical presence requirement. So if you are physically located in Missouri, that's my home state, so I picked it. Then Missouri will consider you subject to tax in Missouri, and then you go through the process of determining how much income is taxable in Missouri, which I'll come back to. So physical presence, where are you actually located? Where are you spending time? So if you're based in Missouri, but you have salespeople traveling to Illinois and physically spending time in Illinois, then that could then expand nexus into Illinois on top of Missouri, where your headquarters are. The states are moving to a concept of economic nexus, that they're not getting rid of the physical nexus requirement, but also creating nexus where you have enough of an economic presence in that state. So in essence, it's looking to a kind of minimum amount of taxation of sales into that state to persons who are in that state that then trigger nexus, trigger a taxable presence in that state. So that could be $50 million in that state, or that could be 10 million. It varies from state to state who's adopted an economic nexus requirement and what the bar is for that state as well. Val also referred to sales taxes as well, which also vary from state to state. So compliance costs can be very, very high from a U.S. perspective, because you have a federal return that you have to deal with, and then you have the possibility of multiple state income tax returns that you have to file, and then potentially registering for sales tax in a variety of other jurisdictions as well. But from an income tax perspective, if you trigger nexus, again, based on one of those two tests, you're subject to tax in that state. You then have to figure out how much income is actually taxed in that state. And again, it varies from state to state. So some states say, what's your federal starting point? And I take that number and then I allocate a portion to states based on sales, payroll, and property, a 3-factor test looking at in-state versus elsewhere. Many states are moving towards a single apportionment factor of sales, sales in-state versus out-of-state. So it's taking a percentage of the total federal income and sending it to that state for taxation based on some kind of allocation or apportionment factor. And what that means is that because each state has a different set of rules in terms of how you apportion income, it's not like if you have 100 of federal income, then 75 goes to Missouri, 25 goes to Illinois. It might be that you have 80 in Missouri and 40 in Illinois, or you have 60 in Missouri and 20 in Illinois. It's just depending on how all those rules shake out. So it's the other thing I will say about state income taxes, because sometimes the cost of compliance might actually exceed the amount of tax at stake. So so many of our clients have to consider, first, well, where do I have nexus? Do I know enough about the business to make sure I'm flagging where I might have an issue? That's kind of point number one. And we've done a lot of work with clients where we sort of look at the past and do what we've described as a nexus study of trying to determine where a company might have nexus based on how it spent its time. And secondly, once you determine that, what's the cost of complying in that state versus how much tax you'd actually suffer in that state as well. So I would say, I guess what I'm alluding to is there's clearly a technical requirement to file in all those states, but I would not say there's a perfect 100% compliance on all of those obligations, just kind of depending on the amount of tax at stake. Okay, so let's touch a little bit on what I'll call inbound taxation. So let's say you're a Finnish company and you start expanding in the United States without a US entity. In other jurisdictions, the way this sort of discussion goes, so let's say you're a Finnish company and you are expanding into the UK, the discussion kind of starts with, do you have a permanent establishment in the UK? If the answer to that is yes, you're subject to tax in the UK, and the income is attributable to the permanent establishment is taxed. And permanent establishment is sort of, do you have boots on the ground in a fixed place of business or premises made available to them? The U.S. discussion starts with, have you created a trade or business in the United States? And that might mean you have boots on the ground, but you don't have a business yet. So maybe they're just providing marketing support. They're not actually generating revenue. They're more of a support function. That may mean you don't create a U.S. taxable presence that if you were looking at other jurisdictions, you might create that taxable presence. So say, do I have a trade? Second, do I have income effectively connected to that trade? And then the treaty can come in, the U.S.-Finnish treaty can come in and possibly change how much tax is due based on if the amount attributable to a PE is less than what we would tax under domestic law. But that's generally the order in which you would apply. We also have a withholding regime that generally deals with the payment of interest, dividends, rents, and royalties from so-called U.S. sources. The starting point is 30% withholding, but that can be reduced by the U.S. by treaties that the United States has. So the U.S. does have an income tax treaty with Finland. It does reduce some of those rates, but there are also some complexities along that I'm going to pick up in just a second. So the starting point of the non-treaty rate is actually quite expensive because if you look at dividends for a minute, from a, say, U.S. company, you're talking about a company that would have, say, a federal rate of 21%, a state income tax rate on top of that, seeks to distribute its profit out, and then there's another 30% that comes off the top unless the treaty comply. That withholding on dividends applies on a tax concept. So this is, I think, one example of many where we have a pure tax concept that doesn't sound all that practical. So we measure withholding on a distribution out of a company, and this withholding based on so-called earnings and profits. So this is not the book income of the company. It's not a distributable reserves concept that restricts the ability of a company to pay. This is simply measuring how much withholding might apply. And you have to basically have a set of special books to determine this amount. It's like a hybrid between book and tax to determine that. We'll do some takeaways at the end, but one of them is, of course, like there's a rather high compliance cost to the United States. So this is just kind of illustrating if you set up a U.S. subsidiary, you pay a dividend to Finland. or you're paying interest, royalties, rents to a sister company, then you need to consider the withholding tax consequences of those payments. Our treaty has something called a limitation on benefits article, which is designed to be a gateway through which you have to pass to determine whether you are entitled to treaty benefits. It is complex in nature. It is intended to be objective, but in reality has some subjective elements. So it's not like a principal purpose of are you seeking the benefits of the treaty as a principal purpose of using of your arrangement. It just goes through a number of different requirements. And most of our treaties have this type of test that's in there. And so what you can find sometimes is that you can get some anomalous results of applying reduced benefits under a treaty. Just going to mention this form as you will be asked if setting up a U.S. bank account to provide this so-called Form W-8BEN-E. This is requested by withholding agents to substantiate who the person is that they're paying. It's about 10 pages long. And in reality, it's not quite as daunting as what it really looks like, but it is a very common form that that is asked for that will requires you to certify who you are and are you entitled to treaty benefits, for example. Excuse me. One exception to this kind of territorial approach of, let's say, Finland sells a US company and just applies the Finnish rules is where you have real estate rich companies. So we have essentially a non-resident capital gains tax that applies to a sale of a US company where the US company at any time over the last 5 years has more than 50% of its business assets value in real property. This can be relevant for startups. So if you are, you're building your plant and you haven't quite started the business yet, then what can happen is you have a taint that could apply for 5 years to this that can make disposals of that entity subject to tax in the United States. So I think it's just something to be aware of. Special rules apply on real estate. I'm going to just finish in the last couple of minutes to talk briefly about the legislative process in the U.S., which I think in my mind always seems mysterious to people who are not familiar with it. The way a bill becomes a law is not from the White House. So recently, President Biden and his administration released a budget, which is a list of tax proposals contained therein. That is really nothing but a wish list from the president that he or she hopefully would like to see Congress do as it relates to tax. So the Congress has the responsibility for tax. The origination of tax is just the way our government works of separating the branches of government. We have two houses in the Congress. We have the House of Representatives and the Senate. Each of those houses must separately pass a piece of legislation. And if they don't pass an identical legislation, that goes to conference and they iron out the differences, and then it goes back to a vote in the House and the Senate. And then once it makes its way through all of that, then it goes to the president for signature. The president can sign that or veto that, and vetoes can be overturned with a 2/3 majority in Congress. So there's a whole, what this is doing is frankly oversimplifying dramatically the steps in the process along the way. And if any of those steps kind of fall down, the process, might just end a piece of legislation. It's important to note, like how important the Senate is as part of this process. The Senate has 100 seats, 2 seats from each state, and there's something called a filibuster within the Senate that is the man on the right intended to depict, of which is standing on the floor of the Congress and basically speaking long enough for the Senate to give up on a piece of legislation. That process of someone just talking and debating a bill on their own can only be stopped with a 60% majority vote in the Senate. So if you have if you are the Democrats and you do not have a majority in the Senate, which frankly they don't, then you run the risk of a bill just not making it out of the process. The one exception to that is if you use the so-called reconciliation process. And what this does is it makes a piece of legislation in part a budget question. You can't filibuster something that goes through the reconciliation process, but that bill has to be revenue neutral within the budget window. And so what you find on a bill that goes through the reconciliation process is that you have aspects that may change over time because the revenue numbers don't exactly work on the front end, or to have that rule be in place permanently. This is incredibly common. The Tax Cuts and Jobs Act that was passed in 2017 and took effect in 2018 by the Republicans when President Trump was in the White House used this process. The Democrats have used this process themselves. And so what we're seeing in the next couple of years is a number of provisions in that Tax Cuts and Jobs Act that are due to expire or change, and many of those relate to taxation of individuals. And frankly, taxation of individuals is really where Congress gets excited, because they do concern it could have more of an impact on their seat, in the next round of elections than, say, the corporate tax vote. So we have something like 30 individual tax provisions that are going to expire or change at the end of 2025. And the expectation as a result is that we are very likely to see some potential additional tax reform in the United States. We might see tax rates go up as well. The issue will be, do we have the right balance in Congress to get that done? So if the Democrats control the House and the Republicans control the Senate, for example, and they can't agree on a bill in conference to get through, or maybe the House passes a bill and the Senate doesn't pass a bill, then nothing actually happens. And that is, again, a standard part of the process. And in fact, when you have this split Congress like this, quite often what happens is that's when the parties go back and they think about what they're going to pass at a point in time when they are in power and have the ability to get things done. Many proposals that are out there that have been passed, like so some of the provisions in the Tax Cuts and Jobs Act were not devised out on the spot. They were taken from proposals in the past, and some of them were even from Democratic proposals as well. And that also comes back to making the budget work. So the numbers have to work. You have to tweak certain provisions to get the numbers to work, or you might just bring in a special rule whose really only impact or only policy impact is to generate enough revenue to make the budget work. So when you're in reconciliation, sometimes it's harder to explain the policy behind some of the rules that apply as well. So the long and short there is that, we're going to potentially see a couple of or another round of tax changes that come at the end of 2025, maybe 2026. I think the expectation there, if we do get that, is that it'll be an increase to rates. So 3 key takeaways here, right? So federal tax is complex and the expectation on documentation is high. Compliance is a big cost of tax compliance is a big cost of doing business in the United States, and in particular as it relates to state tax, because of the variation from state to state and also from the federal tax regime itself. And then finally, the legislative process itself is often challenging, and then you can get some results that you might not expect. Sometimes it feels a little hard to follow what's going on because we'll hear proposal after proposal after proposal, and just sort of what's going on. The answer is there's the old expression, it's not over until the fat lady sings, and that is essentially when the president signs a bill. Prior to that, all bets are, can be off in terms of whether a law will actually take effect or not. So that's all I had. I think we're now going to move into some questions. Is that right?
Yeah, that is correct.
Great. So I'll stop sharing my screen.
Thanks a lot, Tom. Actually, before we dive deeper, there are a few questions to Val as well. But one kind of question to wrap up your piece. Our members are typically growth companies, 1 to 10 million. seeking growth, not only tech, but many of us are tech companies.
Yep.
Are there some common trends you mentioned there are different approaches in how you kind of establish a US entity in terms of legal entity or state where you start your operations in? Do you see any trends that you could kind of talk about that, what are the most common approaches for
Well, I think it's really, yeah, I mean, on the one hand, states will have a variety of incentives to try and attract you to that state. If you are bringing a reasonable amount of substance into a particular state, it is worth a conversation with that state of, hey, is there a deal that you can cut with me? It's a very common thing to do. And the other thing geographically about the United States, I'm going to keep picking on Missouri because again, is where I'm from. So I'm from the city of St. Louis. St. Louis is on the Mississippi River. It's the border, and the Mississippi River is the border between Missouri and Illinois. And the metropolitan area for St. Louis actually covers 2 states. So if you're going to move to the metropolitan area of St. Louis, you actually have a choice of going into Missouri or Illinois. And you could get different income tax results on the back of that. So I think, I don't think it would be right to necessarily say there's like a particular state in question that is where the trend is. I think you should lead by where does it make sense to locate your people, and that could be access. It's the usual stuff, right? Access to talent, transport links. Are you physically shipping? If you're, and if you're tech, maybe it's more on the talent side, right? Focus on that, and then if you narrow it down to a handful of states or regions, then you could look at, okay, where are the differences from a state tax perspective, and then have that be some of the deciders and push on some incentives.
Right, makes sense. Actually, now might be a good time for us to bring in Val into the discussion because this gives quite a nice segue to Kirsti's question, where she's asking that are there other areas than Silicon Valley or Boston to go for market entry? Can you please give some examples which areas are hot right now and for which industries? You alluded to this in your presentation, but can you go a bit deeper into this topic?
Well, we'll start with the 30,000-foot answer. If I knew that, I'd get a Nobel Peace Prize. Every industry has its hotspots. There's basically the key markets, there's the growing markets, and then there's the fringe markets. It really depends what industry. So let me ask you what industry is it you're in, and then I might be able to give you a better answer. But there's pockets all around the United States, so you kind of have to figure out where you belong. It's a little trial and error, and it's a little bit knowing the market. But Kirsi, what industry you're in, and what are you thinking about?
Yeah, hi. Just a second, putting my video on. Here I am. I was curious to hear, because I said like for various industry, the trends change every now and then. So actually medtech is something I'd be interested in, like what's hot right now. Or there's every now and then the discussion, Texas is rising and everybody is moving over there. So it would be interesting to hear whether there's any trends for specific industry. So my question was more of a general nature.
It depends on it. I hate to give you a non-answer, but it really comes down to what you have. If you're looking at pediatrics, I go to Cincinnati Children's Hospital. If you're looking at digital, almost every hospital in the United States is looking at hospital at home right now. So it's an interesting play. It really depends where you belong. If you're cancer, there's 5 or 6 different places that you definitely want to be. If you're in the fitness industry, the wellness industry, I would say you start with IRSHA, which is the Global Health and Fitness Association. It really varies. Be happy to have an offline conversation and brainstorm with you.
Perfect, thanks.
There's actually a question to Tom here. Could you elaborate, does the tax treaty give protection against state income taxes for a non-US company?
You'll hear a lot of US tax professionals answer questions with, it depends. And it does depend on the state and how they treat that. So a state income tax is not a covered tax in the US-Finland treaty. So it's just that you can't automatically apply treaties to switch off or change state taxation. Where the difference comes in is if you have nexus in a particular state, you have to have you take your starting point of kind of federal income tax and then a portion, right? You can differ what your federal starting point will be from state to state. So some might say, well, calculate federal without regard to whether the treaty might switch off the federal taxation, right? In which case, then you're going to have state tax without regard to treaty benefits, even again, if you have no federal tax. Other states will take that starting point as start with federal after you apply treaty benefits. So if the treaty is exempting federal income, then in that state, your starting point is 0, and then you don't have state income taxation. So I would say in some cases, indirectly, you have treaties apply to reduce state taxation, but it's not a direct benefit.
Right. All right. For everyone on the call, now is kind of a final chance to ask your questions. You can either type it in the box or unmute, and we'll start wrapping up soon. But before we go there, could you, Tom and Val, both of you share perhaps a few pitfalls that you've seen European companies encounter when entering US market? What should we not do?
Don't make the assumption because it sells in Finland, it's going to sell in the US. That's the first one. The second one is don't overpromise and underdeliver to your board and to your investors. And the other thing is don't come over here expecting to sell. Come over here expect to learn, and then figure it out from there. You're going to sell by asking questions and not selling.
Yeah, I would say from a tax perspective, try to make sure that you get some documentation in place when you're entering the United States from a tax perspective. And that documentation might be some advice from an advisor. And this is not a sell, by the way. This is to protect you going forward. It might be something that says, I'm not subject to tax, right? That you get a sense of, all right, I'm going to do X. Try to be proactive as it relates to tax, because the pitfall is, and this happens, it's very, it's easily done. You've got pressure to get everything moving. You've got a great opportunity, you jump on, you move forward on something, and then tax comes at the end. And then you find that, maybe you've entered into a JV that is not the right tax structure for you. And that you may have had some influence on earlier, in the JV discussion. Maybe you find that you've entered the US tax net without knowing it, and you have some hidden liabilities that could be federal or state, or maybe you've funded the United States. This I've seen a lot of. You set up a US company, you just throw money into the company because you need it to get the US business going, but you don't actually document what those payments are. Are they loans? Are they equity? And what can happen is that it can be very difficult to unpick all that stuff after the fact. So again, I think just try to be proactive and keep tax on the front end so that you're not trying to unpick it at a later date.
All right. Actually, can you elaborate a bit on those hidden liabilities? That's quite interesting. When do you start accumulating that? Let's say we're selling something to a US company from here and from Finland without having anything else than an internet site.
Well, I would say generally speaking, if you're just like exporting goods out of Finland into the United States to third parties, you're probably going to be fine from a US income tax perspective. There are things like, customs duties and those sorts of things that you'll need to think about.
Mm-hmm.
But as a general matter, as a non-US person selling goods in the United States, federally you'll be fine. There may be some state. You may find that, let's say you're over the economic nexus threshold for a particular state. It may be that theoretically you have to start filing tax returns in a state before federal. I will also say that quite often that may be for a tax amount of little to nothing. So it kind of comes back to, getting the right balance on these things. It's really when you start physically, spending time in the United States that the risks go up.
Okay, makes sense. All right, I think it's time for us to start wrapping up if there are no final questions from the audience. It's starting to be 7 soon here in Finland. So thank you, Val. Thank you, Tom.
Pleasure. Thank you.
Much appreciated. Hopefully, we got a lot of information for our members about the US market. And before we wrap things up, just a few words of advertisement on next upcoming events with Boardman Grow. So next Thursday on the morning, we'll have the monthly Boardman Grow morning coffees with Timo Lappi giving his talk. So very interesting topic coming up. Members, check your inbox for that, and also check the Boardman Grow website for other upcoming events. And later on this year, we actually Boardman will be organizing a trip to the Silicon Valley, and so that will be happening again this year in September. The registration is open at the moment. There's a link in the chat. You can check from there, and there's a cheaper price until the end of March, and there's actually a subset of that group that will go to Los Angeles as well. So that might happen as an extension of that trip. But the idea of that Silicon Valley experience is to kind of do some company visits, have roundtable discussions with other professionals, and get to really know what's kind of bubbling, and especially kind of around tech innovation. And if you want to learn more, go check out the pages from here, and remember to register. Like I said, cheaper price before end of March. But with that, big thanks to everybody for participating. Hopefully you gain some insights into the US markets, and have a nice evening. Thank you.